Friends, welcome to this next video in our series of principles of equity investing. The principle I'm going to talk about today is we need to assess the valuation before investing. So this is our video 20 in our series. I hope you have liked the previous 19 videos. Do offer your comments on those videos. Those are very valuable to me. Do explore my other videos and video series such as learning finance. There is a video series on cost. I am also creating another video series on creating a lasting organization and integrated framework. And I also created a video on SIP. So do have a look at those videos at your convenience. Now, friends, let's talk about these principles on valuation, particularly some of the methods. Let's get going. So the first thing I would like to speak here is this paradigm of price versus value. Now, the price at a given point of time is objectively known to us because the share trading is happening. Some people are buying, some people are selling, and that price is objectively known. But what is not objective is value. Value is something which is very subjective. In fact, because everybody's assessment of value is different, that is the reason why people are buying and selling. So obviously, if our assessment of value is greater than price, then we tend to buy that particular share. If our assessment of value is less than the price, then obviously we tend to sell. Now, sometimes the external circumstances also push us to take these decisions. So sometimes people have completely out of the world assessment of value when going is great, when stock markets are surging, then all kinds of methods are justified to say that the value is so much higher, and then people keep on buying them. And similarly, when there is a bear market like what we have experienced in March 2020 and we are still experiencing in April 2020, people have absurdly low assessment of value, and that's where selling pressure increases. And people who have a little long-term view are able to clearly see that value is greater than the price, and they tend to buy, but people who are under fear tend to sell. So this is absolutely true that we buy if value is greater than price and sell if value is less than price. But it is also possible that we may sell one and buy another if the other stock offers a much better value to price paradigm. So this is also a relative phenomena. Value could be greater than price in many cases, like what may be happening for some of the investors right now, that they have so many choices that they feel that there is value everywhere. The prices have fallen a great deal. But this is where also it is possible that one can prioritize which gives us the highest value as compared to the price, and then therefore decide to buy that stock over others. Or someone else, without putting extra capital because of uncertainty in the current market, may switch from one stock to another. Thus, net exposure to equity market remains the same, but from a value to price paradigm perspective, the portfolio has become better. So all these things can happen. And as I mentioned earlier, value is very subjective thing, price is objective, but we need to have a fair assessment of value. And therefore, let us get introduced to some of the methods. So the purpose of today's video is not so much to get into all the methods in detail right away, but just to introduce you to some of the methods which are used. And then I will create separate videos on different methods, considering the importance that they have and the way they are used in common across these decisions. So we will look at some of those methods as an introduction today and get into more details in later videos. So valuation methods broadly can be three. Of course, there are going to be many variants of this. So one set of methods are focused on the balance sheet in terms of net assets of the company. What are net assets? net assets is an aggregate of all the assets that the organization has, less all the liabilities. So liabilities include the long-term liabilities as well as short-term liabilities. So if one is able to reduce those liabilities, we can actually arrive at net asset of the organization which actually belongs to equity owners. So one can have methods which are balance sheet based methods. The second valuation set of methods are woven around earnings multiple, because finally, why do shareholders or prospective shareholders invest in equities? It is essentially because of earning potential that the company has and the growth that can happen in those earnings. So therefore, earnings multiple methods are also going to be discussed today. And lastly, cash flow based models, which look at today's value of future cash flows. So I'll not elaborate this right now. Let's have a look at the variants, and then in later videos we can go into far greater details. So net asset based methods, as I mentioned earlier, are essentially balance sheet based methods. So if you look at the last published balance sheet, we can find out the shareholders' equity, and that equity essentially consists of the share capital plus the retained earnings. So these two together will actually give us the book value as per the published financial statements. Now we could arrive at a ratio which is price to book. Again, today I'm not getting into all the details. I'm just introducing the ideas here, and then in the next videos we'll actually build this discussion in a greater detail. The second method is replacement value. So again, in the balance sheet we are able to see different kinds of assets, particularly if a company has assets which are of the nature of property, plant and equipment. It has land bank which it bought many years ago, and today it is running its factory on that, or it is running its service operations on that. The historical cost at which those assets were acquired and its current replacement value could be quite different. In fact, the current replacement value could be significantly more as compared to the cost at which those assets were procured many years ago or decades ago. So replacement value based methods are also possible. The third set of methods are where it is more under duress. In case we were to actually sell off all the assets, liquidate the company, then what would be the value for the equity that would be left? So this is ultra conservative. Generally this doesn't happen that the company would be liquidated, but there could be circumstances where liquidation value method would be more appropriate. Fourth is net asset value. Now one may say that this net asset value looks to be similar like book value, but net asset value as a method of valuation is more applicable in case of holding companies, companies which are in the business of owning stakes in different companies. So we have a lot of holding companies in India which belong to promoter groups, and through those holding companies they actually hold stakes in multiple companies, and in some cases these holding companies are actually listed in the stock market. Now their book value is not representative because book value again is based on historical cost, but if you are able to look at what is the current value as prevailing today based on their equity ownership in different companies, we are able to arrive at net asset value quite dynamically. So again, we will talk about this a little later in the later videos. And it may also so happen that a company is in a particular business, but apart from that it has acquired huge land banks in the past, and either it is monetizing those land banks by real estate development, or it has a potential to sell those land banks. Then the valuation can also be quite different, because those lands, though they are not being currently used in the business, have the potential to generate cash flow for the company. So this also we will look at in a later video in greater detail. The next set of methods is earnings multiple methods, because as we discussed earlier, the purpose of investing in a company is essentially the potential for its earnings to grow over a period of time, and therefore the kind of price movement that can happen in the future in response to the earnings growth. So price earnings multiple is a very commonly used method, but at the same time it is quite often misunderstood and misinterpreted, because obviously it has certain limitations also that we need to be aware of. Again, these are going to be discussed in later videos, but again, this P by E ratio can be calculated based on the historical earnings, or it can be calculated based on forward PE, which is based on the estimated earnings which are not yet reported. One other variant of the price earning multiple is what is called as power PE or PE by G method. Again, right now I don't want to burden you a lot, but this is a refinement of the P by E multiple by taking into account the potential growth. So again, this is something we can talk about in greater detail. One more method which is used is EV by EBITDA method. EV indicates enterprise value, and this enterprise value is the collection of the equity valuation plus the debt valuation, and this can be compared with what is called as EBITDA, which is also cash operating profit. So this is something again we can discuss in greater detail separately, but this is something I thought I'll just mention briefly. Last method is price to sales multiple. Now, in case of companies which have not yet started reporting profits, or the new economy companies where generating sales itself is a great achievement, price to sales multiple can also be used for valuation. So this is another method. We'll talk about this in greater detail. Lastly, analysts use cash flow based valuation models. For people like you and me, it becomes very difficult because we don't have so much access to management. We don't have time to go into the analyst reports in great detail. So therefore, as common investors, we may not be able to use it very effectively, but so that we are aware about these methods, I thought of just mentioning these methods here in this video. So the two methods are dividend discount model, and within dividend discount model, again, there are two variants. There may be multiple more variants, but broadly a constant growth model and a two-stage growth model, where constant growth assumes that the company is going to grow consistently at the same rate for foreseeable future, whereas two-stage growth model looks at a more realistic period when a certain growth can be achieved, and then a longer period where it is very difficult to estimate what the growth would be, and therefore we assume a constant growth during that time, which is less ambitious as compared to next few years, let's say 5 years. And another method which is also used by analysts is the free cash flow based model, which is again used for arriving at the enterprise value, and then by reducing debt from it, we are able to assess the equity valuation. So we will deal with these methods a little later in individual videos, but I would just mention here that once we arrive at the equity valuation or look at its reasonableness, in some of these methods or models, we have to arrive at per share value, because then finally it is the per share value that needs to be compared with price. It is not the aggregate of equity. If we have to use the aggregate of equity as per any of these methods or models, then we need to look at what is called as market capitalization, which means the collective value of equity. Then we cannot compare only the price of one share. We'll have to look at the market value of all the shares put together. So I hope in this video you got a good idea about various methods which are used, but we will go into those details one by one in separate videos. So friends, I hope you like the video, and if you have, do press the like button, share this video series and this video with your friends. Your encouragement matters a lot to me. Do press the subscribe button to be notified about new videos, as well as press the bell icon so that you get the notification the fastest. Use playlists that I have been creating especially for different topics to enable you to see videos in the desired order. Thank you for your patronage.